Goldman Sachs made $21 billion in revenue last year. JPMorgan made $63 billion. Morgan Stanley made $55 billion. These are staggering numbers. But here is the question nobody asks. What exactly are they selling? They do not make products. They do not provide services most people use. They do not create anything physical. Yet they extract billions from the financial system every single year. The answer is both simple and deeply uncomfortable. Investment banks make money by being in the middle, by taking a cut of every major financial transaction that happens in the world. And by the time you realize what is happening, you have already paid them. Let us start with what investment banking actually is. Most people think a bank is a place you deposit money. Investment banks are different. They do not want your money sitting in an account. They want to facilitate massive financial transactions and take a piece of every one. An investment bank does four main things. It advises companies on mergers and acquisitions, it underwrites securities, it trades on its own account, and it provides financing. Each one is a revenue stream. Each one extracts money from the financial system without creating anything new. They are just redistributing existing wealth and taking a cut. Let us start with mergers and acquisitions. Company A wants to buy Company B. This is a massive financial transaction. Maybe it's worth billions of dollars. The CEO of Company A calls an investment bank. Goldman Sachs shows up. They tell Company A what they think Company B is worth. They tell Company A how to structure the deal. They introduce Company A to potential financing sources. They negotiate with Company B's investment bank. They draft the documents. They manage the entire process. For this work, they charge a fee, typically 1 to 3% of the deal value. On a $5 billion deal, that is $50 to $150 million. For what? Advice, introduction, document drafting, negotiation, all things that could theoretically be done internally or by lawyers directly. But investment banks control the process, and they charge enormous fees because nobody really knows how to value this work. The fee is whatever they can get away with. Now let us talk about underwriting. Company A wants to go public. They need to raise money. They hire an investment bank to manage the IPO. The investment bank researches the company. They determine what the stock should be worth. They market the stock to investors. They structure the offering. They manage the entire process. Here is where it gets interesting. The investment bank typically buys all the shares from the company at a fixed price. Then they sell those shares to the public at a higher price. The difference is their profit. It's called the underwriting spread. On a large IPO, this can be 20 to 30% of the total offering value. On a $2 billion IPO, the underwriting spread can be $400 to $600 million. But wait, the bank is also taking advisory fees for managing the IPO process. So they're double dipping. They're taking underwriting spread plus advisory fees on the same transaction. Now let us talk about trading. Investment banks have massive trading desks. They buy and sell securities, currencies, commodities, derivatives, bonds, stocks, everything. They trade on behalf of clients, and they trade on their own account. When they trade on behalf of clients, they charge commissions. They also charge bid-ask spreads. They buy a stock at $99 and sell it to a client at $100. The $1 difference is their profit. On billions in trading volume every day, these tiny spreads add up to enormous profits. When they trade on their own account, they are using their own capital to make bets. If they win the bet, they keep the profit. If they lose, they take the loss. But here is the key. They have an enormous advantage. They know what clients are about to trade. They see the order flow. If a major pension fund is about to buy 1 million shares of Apple, the investment bank can buy Apple shares a fraction of a second before the pension fund's order hits the market. Then they sell those shares to the pension fund at a slightly higher price. This is called front-running. It is technically illegal, but the ways around it are legal. They just need to separate their trading desk from their advisory desk, put up a wall. Then they can trade on information that is technically public but not yet widely known. Now let us talk about financing.
Investment banks make loans. They provide credit lines. They structure complex financial products. They package loans together and sell them as securities. They create derivatives based on mortgages. They create synthetic securities. They create products so complex that even the banks selling them do not fully understand them. For all of this, they charge fees. Origination fees, servicing fees, advisory fees, structuring fees. They charge for creating the product. They charge for selling the product. They charge for managing the product. The same product generates revenue multiple times over. Here is the key insight. Investment banks do not make money by creating value. They make money by extracting value from transactions that would happen anyway. A company would go public with or without Goldman Sachs. A merger would happen with or without JPMorgan. But these transactions would be cheaper. So the investment bank inserts itself into the middle and takes a cut. The real question is, how do they justify these enormous fees? How do they convince companies to pay billions for services that seem to add limited value? The answer is information asymmetry and complexity. A CEO does not know what an IPO should cost. They do not know if the investment bank's valuation of their company is accurate. They do not know if the underwriting spread is reasonable. They do not know if they're getting a good deal. So they hire the investment bank that did the most IPOs last year, the one with the most prestige, the one that seems to know what they are doing. This creates a perfect environment for charging enormous fees. Nobody can really compare prices because every deal is unique. Nobody can really evaluate the work because it is invisible. And the investment banks all charge similar amounts, so there is no competitive pressure to reduce fees. The deeper mechanism is that investment banks have a structural advantage. They sit at the intersection of all major financial transactions. They see information flowing through the system that nobody else sees. They know which companies are about to be acquired. They know which companies are going public. They know which investors want to buy which securities. This information is gold. It allows them to front-run trades. It allows them to structure products that benefit themselves at the expense of clients. It allows them to charge fees that seem absurd until you realize nobody else has better information. Now here is where it gets uncomfortable. This system does not just affect the ultra-wealthy, it affects you. When you buy a stock through your brokerage, an investment bank likely took a cut. When you get a mortgage, an investment bank likely structured the loan and packaged it for sale. When your pension fund buys securities, investment banks took a cut of the trade. When a company's stock price moves, investment banks often moved it through their massive trading operations. The fees are hidden. You do not see them. You think you are paying your brokerage a small commission, but the brokerage is routing your order through an investment bank that is taking additional profit. You think you are getting a fair mortgage rate, but investment banks packaged your mortgage, took a fee, then sold it to investors who took another fee. The costs are hidden inside the system. Investment banks employ tens of thousands of people. They pay enormous salaries. A managing director at Goldman Sachs makes millions per year. A VP makes hundreds of thousands. Even analysts fresh out of college make hundreds of thousands. How do they afford to pay these salaries? By extracting billions from the financial system every year. The irony is that most of this wealth is not created, it is redistributed. An investment bank makes billions by taking a cut from transactions. That cut comes from somewhere. It comes from pension funds that get lower returns because they paid bank fees. It comes from companies that pay more for capital because investment banks charged fees. It comes from you through hidden fees buried in products you use. So here is the uncomfortable question. If investment banks make money by being in the middle and taking cuts of transactions that would happen anyway, if they do not create products or provide services that could not be provided more cheaply, if their business model depends on information asymmetry and complexity that hides what they charge, and if this system redistributes trillions of dollars from savers and companies to investment banks every year, then what exactly are we justifying when we accept this system as normal?